Good morning, everyone, and welcome to another installment of the Prosperity Through Multifamily Real Estate Investing Podcast. I'm your host, Real Estate Cody, and with me, as always, the coffee connoisseur himself, Mr. Brian Alfaro. Good to see you, buddy.
Morning, Cody. Nice to see you.
Always great to see you. Always great to be here in the hot seat, having another great conversation, talking about our favorite passion in the world, commercial real estate, investing, and whatnot. So we got a great guest here. Tell the audience who we're talking to today.
Absolutely. Today we have Scott Choppin, and Scott is the CEO and founder of the Urban Pacific Group of Companies, a Long Beach, California-based real estate development company founded in 2000 that focuses exclusively on workforce rental housing communities throughout California and the Western U.S. Urban Pacific has created a new housing innovation called Urban Townhouse, which pairs private capital and middle income multi-generational rental housing while producing market superior yields on invested equity. Historically, Urban Pacific's UTH projects have delivered 22.66 programmatic IRR yields on equity. With over 35 years in the development business, Scott is a leader in the field and is a regular contributor to major media outlets throughout the nation. Scott has been published in Forbes magazine, GlobeStreet.com, Los Angeles Times, Builder magazine, Affordable Housing Finance, Affordable Housing News, and most recently, the cover and feature article about the UTH housing model in Multifamily Executive magazine. Scott and his wife Becky have been happily married and together for 27 years and are raising their three kids in Long Beach, California. Welcome to the show, Scott.
Good to be here, guys. Appreciate the invite.
Scott, great to have you on, man. Really looking forward to our conversation. And just listening to your bio, doesn't really sound like you've done a whole lot in real estate, man.
I know. I've been just slacking, hardcore slacking.
No, man. Hey, great resume. Very, very impressive background. You definitely had my interest, Brian, when you were reading that about, your yields and what you've been able to deliver on your equity. So looking forward to diving in, man. Tell us the audience a little bit more about Urban Pacific and what exactly that it is that you guys do.
Yeah. So, we're really in a big picture sense, think of us like we're a real estate development company. So we really completely focused on ground up development projects and have been. Now we're 22 years since I formed the company. And that's really all we've done. I mean, we've done some adaptive reuse, taking old buildings and converting them into new lofts, but no investment in value add. We hold some of our assets as investments, but those are post-development always. And then more recently, we're basically creating a fund around this workforce housing model that we'll talk more about today. So it's real estate developer and really emerging fund manager, be a way to think of us in a big picture sense.
Awesome. Yeah, very exciting, man. And I know that the development pipeline is definitely in high demand right now. I mean, obviously, it's no secret we have a very significant supply and demand imbalance. So, developers are definitely have their plates full over the next several years trying to keep pace. But Brian, I don't think we've ever asked any one of our prior development guests on the show, like, Scott, what would drive you to do development versus buying existing?
Yeah. Great question. So there's a few different ways to think about it, but I like the place I go first is like I had a family background in it. So my dad and my uncle were both developers in their own right. And so I grew up around the business. Although, as a kid, you don't necessarily understand what, is all entailed of, actually being successful and making money and profitable projects and development. But it was really from the time I decided, when I was, in my late teens about like thinking about a career, I had watched, these guys that I both admire, my dad and my uncle, be successful and create new projects, right? Like that's, obviously it's real straightforward. You're creating a brand new building from something that didn't exist before, either an empty lot or, tearing down something older. And primarily it came from that, right? I mean, I don't want to say it's all I knew. In fact, the story I tell was, when I was 18 or 19, I was like sort of in that, time period when you're trying to figure out, well, like what the heck are you going to do for the rest of your life? And I had been working construction for a couple of years, just wasn't necessarily pointed at college, nor was I pointed yet to pick the career of a real estate developer. In fact, to some degree, when you're a kid, you don't want to do what your family does. You try to do something different. But after working construction for a couple of years, And as an electrician, I worked on all new projects. I mean, we did some remodel, I should say. We did both, but I was around a lot of new construction. And so I like that environment, right? Creating new buildings, new space. And this is long before I understood, the undersupply story that California has been in for, decades, probably my entire life for that matter. So I got that exposure to construction and seeing new projects being developed. And I was working in construction, nothing related to my family, but it was in the apartment business. And then at that time I was, I do a lot of reading, and I did a lot of reading then. And I came across a book. It's one of these classic 50s era, real estate investor on the weekends type of books, like literally how to make $1 million investing in real estate on the weekends. Like, I think that was the actual title of it. And so when I started to think about putting those two together, so although that didn't cause me to go into investment per se, that's what the gist of the book was. It taught me, I go, oh, here's what a deal maker what deal making looks like in the new construction business, right? Like, I sort of mashed those two together. I mean, nothing brilliant, just me sort of like coming to the realization that there's a way to produce value of taking, empty land and building a new building. So that sort of came out of that, thought process. And, here's where I think of development. Development is the ultimate form of value add, right? So we talk about value add of buying an existing apartment building and doing something to change the value, to upgrade the capacity to generate NOI. Well, that's what development is, except in a really extreme version of it, because you got no building and you're going to create a new building. And that, is intimidating. I talked to a lot of people that are like, yeah, I just, it probably makes sense to look at development. But I just, creating a brand new building out of scratch and not having an existing asset that I can invest in initially, that has a, it's a different risk profile. But of course, when you're a developer, your job is to figure out how to mitigate that risk profile. And then, value add and development are going to catch different parts of the market cycle, not diametrically opposed, but, right now development seems to be, in a better space for producing returns than value add does, given the, sort of values that people are having to buy at.
I think Brian and I, we would probably be lumped into that category of people that said, yeah, you see the potential, you see the upside in development. But to your point, it is a very different business model than what we're doing, buying existing, adding value to existing. And so, that's kind of been a reason why haven't gone down that route just yet, because you're right that the timelines are different, the structure of the deal is different. The whole business model is different, but I love the way that you phrase that. And it reminds me of one of our prior guests, who's also a former development, who kind of shared the same thesis that, like you said, this is the ultimate form of value add. Like you're capturing all the initial value add upside because, like you said, you're taking it from just shovel ready dirt to, having an existing business.
Or not even shovel ready dirt sometimes.
Yeah, exactly. Exactly.
Purely raw land. Yeah.
Definitely. So Brian, before we keep going in here, any thoughts so far? I mean, I know you and I, we've talked about this internally a lot and we get asked often, hey, are you guys doing development, things like that?
Yeah, I think this is definitely something that's needed. And I'm very curious for Scott to go into detail on their development of workforce housing, because we've been hearing this for years, is there's a lot of development in the pipeline. There's a lot of things coming down in the next few years, but it's a lot of A-class product. It's a lot of things that maybe people can't afford. So hearing a little bit more about their strategy with the workforce housing and their new development there, I'm definitely curious to hear more about it, because we like this space. It's definitely a need right now.
Yeah. No, happy to address that. So, I mean, being a developer, you travel with the marketplace, right? With this area, this geography is good for, development, growth, this type of unit. And so we're always looking for that trend. But I will say this, and I think this is probably true for lots of the people in the real estate community generally, in both investment and development, is there tends to be sort of this like follow the pack mentality, right? And when I started Urban Pacific in 2000, we were specifically looking for niche opportunities. Like, it just, for me and my background, I can't tell you why, guys, but when I decided to start my own company, I didn't want to try to go compete with everybody else. And I didn't think of it in that way, but I was looking for niche opportunities where you could produce better value. Maybe you could, buy a more strategic site and then, like have advantages come from that, better profitability. Maybe you could attract, more or better investors. And so we actually started in what we call the urban infill environment. And that was basically taking underutilized and vacant parcels inside of existing neighborhoods, existing cities and metro areas, and developing new housing inside those, that existing neighborhood fabric. And back in 2000, that was not the typical. That was, in fact, we got a lot of reaction from investors when we first came out. We take them out to the neighborhood. Like I remember we brought investors to downtown Long Beach, where I'm based. We have done a lot of development in our hometown. And, these investors were like, oh my gosh, in those days it was, pretty minimal homeless population, people panhandling it. But, from some dude from Orange County who was, lived in the clean, pristine, suburbs, coming to this urban environment was like, strange, right? Like it wasn't cool at that time. It was becoming cool to live in downtown, but we were at sort of the front edge of that, right? So I tell that story because that really is the genesis of our thinking process, and why I formed the company was to capture these sort of niche opportunities. And then we did that whole entire time until 2016. And we had a set of deals that were post GFC. We bought land, did really well, sold all those things off. And 2016, 2017 was an interesting time because it was like the first group of deals had come through, at least in SoCal, Long Beach, and the markets that we worked in at that time. And then I remember distinctly that lenders and investors started to they're like, well, hold on, doing more, maybe not. This was sort of the hangover, the PTSD of the GFC, right? Like people didn't want to be too aggressive in lending or investing. And so there was a little bit of what I call a flat spot, right? So lenders pulled back, investors pulled back. And so that gave us, we had a series of deals. So we shut all those down. And we said, okay, so the market's changing in some way. How can we look at this, in a unique, uncommon way so that we can both avoid competition, create better returns, and then attract capital and have something differentiated. And so that was at the time that we created this urban townhouse model that Brian's referencing, or UTH for short. And really the idea was to basically look at a sector of the marketplace that was really totally underserved. And when we began that, we didn't know who that was, but we had this idea. I won't go into, biography, but I spent several years working for a big home builder division that did affordable housing, tax credit, real estate development, ground up, using government subsidies, that kind of housing. So I had this background of families that were in need. And of course, we're in California, which is, the most expensive, housing marketplace generally in the United States, and we're undersupplied and all that kind of stuff, right? And so we said, hey, let's figure out a way to not compete with everybody else. Let's figure out a product that is unique, that nobody's serving. And so we came up with this idea of what ultimately became Urban Townhouse, which was to build a build to rent model. In fact, we didn't call it then, and that build to rent market's exploded. In fact, I used to say, I still do, design and built to rent, but lives like a house. Right. So that was sort of where we started from the architectural format. Infill, again, our background, downtown, peripheral downtowns, B and C neighborhoods would be the way to think of it. And then as we started to develop this townhouse model, which ultimately became a 3-story, 5-bedroom, 4-bathroom unit type. That's really that's the unique heart of urban townhouse, is that it's a multi-bedroom townhouse model, 2-car garage, 5-bedroom, 4-bathroom. And then as we started to think about who would rent here, it would be, at first it was like roommates, people that would share. But then as we did more and more of the projects, we started to get people who were family oriented, right? And they're like, oh, I remember our first deal, a guy who worked for one of our partners. He was like a runner for the company that the investor worked with. And he came and saw the unit. He's like, oh, dude, this is totally perfect for my family, mom and dad, 3 kids, grandparent. And what's interesting is, like, for him, his church was just close by, a few blocks away. His job was probably 15 minutes drive from where the unit was going to be. He didn't ultimately end up renting there. But this really is like, I watched this sort of narrative develop and I go, oh, this is, background in affordable housing, trying to do a niche, multiple bedrooms seem unique, we're generating pretty decent sized rents and therefore great returns. And so that started to morph into what now is basically purely a multi-generational housing offer, UTH, to serve middle income working class families. And so I describe that is workforce housing, and everybody has a different definition of what workforce housing is. But really, the think away is we're pairing private capital with this workforce housing model. So we don't need government subsidy. We're creating new units in the marketplace that don't exist, and we're serving a family demographic that is completely ignored by the development marketplace.
Yeah, I love the model, Scott, and want to commend you too. I think anybody that's going out there trying to really tackle this, really, I don't want to call it crisis, but very significant shortage in the workforce housing space. And Brian, you were alluding to this earlier, right, where there really is a gap between your housing supply that's really providing a home for your maybe higher income demographic, your working force, work class, white collar demographic, excuse me.
Yeah.
And then you look at the workforce housing space, and you're not seeing a lot of that inventory or supply that's at an affordable cost now for the average American family now. And we're seeing that gap widening even more. So commend you guys for tackling that problem.
Yeah, appreciate it.
Yeah, of course, man. So this is a very interesting model too. To your point, we have seen the build to rent model really explode over the past several years. And, we know a lot of guys ourselves that are having a lot of success with that. So very interesting model, but I've got to imagine, is there any type of headwind that you're facing when it comes to the development input costs and providing this product at an affordable cost to ultimately your resident?
Yeah, definitely. Yeah. That's like hot top of mind right now is inflation of construction costs. So we're seeing increases there, but we're also seeing increases in the rental rates and the valuations. And so my story right now is watching the rate of change of those, because of course they're not going to go all up and down at the same rate. We wish they would, and the ratios would stay, even with each other, so we can continue to do profitable projects. So we're real watchful right now. The word I use is vigilant, right? So we're able now, we just got done bidding a project in our, to build the UTH project in our hometown. Numbers came in and they were in line with what we had underwritten probably 6 months ago. So what we do is we're underwriting new projects. We'll tend to, sort of use today's price and then try to do some anticipation of, what the per dollar per square foot inflation is going to be. In this case, I landed real close to it. And we don't always, sometimes we're a little ahead, sometimes a little behind, right, on the comparison of, projected square footage hard cost versus the actual. But we're maintaining right now. Rents are going up, not at the rate of change that we would like to see to maintain, the same margins. I mean, we're still producing, low to mid 20s IRRs. Partly that's our projects, aren't like, 300 or 400 unit projects, or delivery of, build out, lease up and sale or refi for a perm loan is pretty fast, right? Like we purposely, when we did UTH in the beginning, no one had done 5-bedroom, 4-bathroom rental townhouse product that we could find. And so we took the first 4 projects and made, created what I call a demonstration phase. Like we did a series of projects, like real close, like all of them, in fact, were all 4 of those, 3 out of the 4 were in our hometown, Long Beach, and 1 was in Orange County, like, probably 15 minutes away from our office. And we did that purposely because we wanted to test the model, right? No one had done 5-bedroom, 4-bathroom product. What does it rent for? What does it build out at cost-wise? And really importantly, most importantly for everybody, is what's the valuation of that? Like how do perm lenders underwrite it? How do the appraisers look at it? How do buyers, when we sell them, how do they look at it? So we did this early demonstration phase, and that tended to be small and mid-sized project on purpose, because my story was, hey, if it blows up and it's mid-size, then we're going to be okay. Like it's not going to take down the ship, with the project. And so we're definitely doing much bigger projects now, but we're still in the story of small projects, and that allows us some flexibility. So when March of 2020 came, we were in this interesting space where we could start new projects. And so what we did is we started a couple small projects close in town. I thought, okay, these are ones that we can manage much, much, much more closely. We bought the land really well. We knew the city. We knew, these were by right zones, so no entitlements. And then what we did is we put our big projects, we extended the timelines of the entitlement process. So rethink, rezone, general plan amendment, site plan review, and that kind of thing in California. And so that created a space where from March of 2020 to really late 2020, where the world was deeply disrupted from coronavirus. I mean, the leasing season in 2020, like summer, normally your big leasing season for families, particularly moving schools, and May and August are sort of your key dates, right? School ends and school starts on the other side. We had none of that. Like the seasonality of our leasing for families was completely gone because kids weren't in school in the way that they were, remotely, I guess would be the better way to say it. And still, even given that, we leased up very successfully. So the product type is resilient, right? So one of the interesting things about this family demographic is that it's always going to be a related family. So think parents, grandparents, in-laws, sometimes, married children, adult children that live at home. And the unit is conducive to sharing economies, right? Income and expenses. And that allows these families to be really resilient in a downturn, right? If somebody becomes underemployed or unemployed, there's 3 or 4, sometimes more other income earners in the family. In fact, our term for that is multi-earner household. And that really has turned out to be a real key for resilience in a downturn. It also happens to be a benefit when housing costs is rising, right? It gives the capability to share that cost over the family group. That's why they exist that way. And by the way, we didn't create that. These families are out there in the marketplace living this way. They just don't have a housing type that facilitates their family to live together. Maybe they're living in 2 units, right? We find that a lot where, grandparents and maybe an adult child live in 1 unit and parents and young kids live in another unit, maybe adjacent, maybe a few blocks away, but always usually in the same, area, like, town or local region. And so our unit basically pulls them out into one household, and they got a 2-car garage, it's like a house, right? 2-car garage, 5-bedroom, 4 bathrooms, quartz countertops, got, wood plank flooring. I mean, it's equal to any A product that you would find, but it's not luxury, right? It's intended to produce space, 5 bedrooms for this family to go exist together. So anyways, I went off track there a little bit, guys, a tangent in my answer, but hopefully that answers your question.
No, it did. And I appreciate the elaborate explanation there because it gives us a better insight into the actual model. It's not just your traditional, 2-bedroom, 2-bathroom townhome that we're accustomed to seeing right here, right, Brian? I think that's probably a lot of the product that we see in this type of space. So, and I think what you're doing, again, you're solving the problem of really providing housing for a family, right? Which is the biggest challenge that people are having now, is finding that affordable, and I use the term affordable, but cost effective housing that people can afford. And
I like that. Cost-effective housing.
Yeah, cost-effective housing. And then really, when you look at the price of residential real estate, Brian, I know you know this, we talk about this all the time, right? I mean, median household values are just accelerating, and it's pricing people out of the market. So what are the alternatives? And I think you're providing that product. So
that's right. Yeah.
I want to kind of switch gears here a little bit, Scott, and really kind of talk about this on the investment side, if we can, because you mentioned, you're still seeing low to mid level 20% IRR, which is, Brian, we're not seeing that anywhere in existing multifamily right now, unless it's got a lot of hair on that deal, right? So, that can be very attractive and appealing for an investor that is looking for that significant upside. Talk to us a little bit more about how you're structuring these deals with your investors, where are your investors coming from, and what the model looks like.
So the type of investors ranges very broadly. So on the small and mid-sized projects, it tends to be high net worth, small family office. We'll usually, a lot of times we'll syndicate a deal, and the capital stack's really vanilla, right? 75% LTC. We raise the rest, 25% as equity. Nothing real special about that. And then, if we're going to hold it, we'll just, go get a perm loan, pretty typical stuff. Fannie, Freddie, it's got, every lender seems to like this product category, commercial banks, some private lenders, although their rates for perm loans are usually not what we want to look for. So on the construction and, debt and equity side, that's pretty typical. We do have then when we start to get into mid-size and large projects, it will usually be third-party funds or third-party syndicators that come in. So as an example, we have a relationship with a group in Tel Aviv who raises capital in Israel and then invests. I mean, they're global, but they happen to have a big presence in the United States. So we'll work with groups like that. We'll work with domestic funds. And then more recently, probably in the last 3 years, so about 3 years ago, I started to think about the next recession. And this even predated, COVID. Nobody could have anticipated that, true black swan. But, before COVID came, we had the yield curve had inverted. The story, the narrative of the marketplace is, we're 10 years in this economic expansion, this cycle, longest expansion in U.S. history, which is great when it's happening. But then you go, oh, what's after that? Right. And that's, what 2008 taught all of us who went through that is to not trust anything. And particularly when I start to hear things like longest ever, best ever, highest ever, right? Whatever the narrative is, I call that, peak market thinking, right? It's like, in fact, I still have it in the library behind me. I have a book I put together of just articles that I, cut from the newspaper. This is how long ago that was. And magazines. And it was basically sort of a combination of articles that said, Wall Street Journal, opinion columnists, financial opinion columns. Oh, the housing market's the best it's ever been. It's going to keep going this way forever. It's never had a down year since 1930 with a cool graph that did this, right? You look at that and you go, oh, this is the Wall Street Journal. I can't remember the guy's name who wrote it. And so I clipped that article. And then the other one I clipped that I can remember was the cover of Fortune magazine, a guy named Tom Barrack, who is founder and runs a group called Colony Capital, one of the big hedge funds, equity funds. And he, in 2005, he said, I'm getting out of real estate. That was the cover. I'm Tom Barrack and I'm out. And I remember seeing that, I kept that one because it's at the time, 2005, I go, man, it's so good right now. The market's crazy great. This is so good. And you look at this guy and he looks nuts, right? But I kept that because after the, what hit the fan, I was like, oh, that's what he was saying. That was sort of the story I had. And so really then all this carries forward to thinking about the recession. So again, I got off track. So sorry, guys. So I'm answering the return, question, right? Yeah.
Yes.
Okay. So we went long-term hold. We said we want everything long-term hold. And the story was to basically be able to have equity structure that could carry us through whatever the next recession was going to be. And I'm still in that story. We still sell strategically, if that makes sense. And the market's as good as it's ever been right now from a valuation standpoint. So, we basically put all these together, and then our model itself, because we have these large units, lots of bedroom space, and a big whole dollar rent. Right now, we're probably, I would say our average rent's $39.50 for a 5-bedroom unit, 1,750 square feet, $39.50. You can do the math for the per square foot. But interestingly enough, what we end up is at $780 per bedroom. That's the real key metric that we track. And when you compare that to any other 1-bedroom or 2 bedrooms, we're 30 to 50% below the market on a per bedroom basis. And that's how these, we're not renting per bedroom legally or in our lease structure. But when the families walk through, this is how they look. They go, oh, hey, that's your room. An adult child, you're going to pay this much. And we're the parents, we're this room, we're going to pay this much. That concept of economic sharing really is pervasive in their thought process. And so what all this does is it coalesces into a development model in a market and a demographic and a time in history where all these things come together to generate, pre-inflation, we're easily mid-20s to hit, let's say mid to high 20s on an IRR basis. Inflation is sort of tamped that down a little bit. So we're 22 to 25 on numbers that we're running right now. And then, but what we go, but it's with a resilient tenant base, right? We didn't have a single collection issue during the, coronavirus. We're in California, our politics are crazy here, and eviction moratoriums. We still have eviction moratoriums now. And we were very fortunate. We didn't have a single rent collection issue because in our conversations with tenants, they're like, look, I cannot get a unit like this anywhere else. If I get out of this unit, where do I go? I rent a house that's 7, 8, 9,000 a month, or 5,000 a month, right? And you're, 3750, 3850, whatever the rent that they're paying at the time. So we really have a tenant that's resilient because of multi-earners. We have a tenant that wants to stay in the unit. I sit on the board of the USC Lusk Real Estate Center. Richard Green is the executive director there, and he's done studies of rent collections by income and demographics. And what he found is that the collection issues predominantly are upper, middle to upper income households were the worst in collection because they sort of, they didn't, I don't know what the logic was, but they sort of knew the system, they knew they could get away with it, where he found that low and middle income renters, think working class is where we live, no collection issues, or much lower collection issues, with the caveat though, that the families are under pressure. Like he was saying, the propensity to pay rent on credit cards was much higher in those, lower and middle income demographics, which, we'd never want to see. And we don't accept credit card payments. I mean, maybe people are putting it on their credit card and we don't know it, but we don't, prefer to see somebody who's, under that kind of duress. So, as all that shapes into this model that basically, because of the high whole dollar rent, the resilient tenant base, the undersupply, like there is no unit like this in the marketplace in Southern California. It basically has produced a very good return over, now it's 6-7 years that we've been doing this program. And then we're back to this, vigilance of, inflation of construction costs and rents and values, and, how those ratios work together. So I know that was a super long answer. So let me check in with you guys and make sure that, you guys got some value out of that.
No, great answer again. And Brian, have you been picking up on some of these like different thought processes, or really like, philosophies here? I've been writing down a couple of your terms that you've been mentioning, Scott, economic sharing, and just how that incorporates into the model. And then, and putting that into perspective, it really makes a lot of sense when you talk about the overall unit itself, and you're saying, okay, we're charging 3,500, and that sounds crazy to us because we just don't see anything like it here.
But that rent sounds super high.
Yeah. But when you break it down to like, okay, per unit basis, though, looking at this is 780 per one for one bedroom, for example, that then becomes a little bit more of an eye opener. Like, okay, yeah, like I get the economics there. Like it makes a lot of sense. And Brian, I mean, come on. Are we finding any, one bedroom units here in our markets for 780 and not seeing a whole lot of them?
No way.
So, yeah.
No, I really like this model. I think this is, you look at workforce housing and affordability of housing, and there's no one thing that's going to fix it. Mm-hmm. But this is a piece of the pie. It's a piece of the puzzle that can provide a solution to a lot of people. Because what we don't realize is, culturally speaking, this is actually very common in a lot of households where there's multi-generational housing, and you're even starting to see some larger builders produce products like this. Lennar has a product called a next gen home, which basically has an apartment attached to it. It's not quite as big, I'm sure, as what Scott's building, but the developers are aware of this. They're aware of that this multi-generational housing is actually a way to prevent, or a way to help with the affordability housing crisis that we have here in America. So I think this is an attractive investment vehicle, and it's definitely, I think I see something other people starting to do as well. As you alluded to, Cody, as the single family houses just get unaffordable, we're starting to creep up to 350 here in Houston as the median home price. If you're looking to start a family and you're looking to buy your first house, you probably can't afford it. That's a $70,000 down payment. If you're putting 20% down, you don't want to be over leveraged. Then you're looking at still having a really high mortgage after that. So this multi-generational housing makes a lot more sense. More people can pull their money together and either put a larger down payment down if they are buying, or if they're renting, they can chip away at it from a monthly basis. And as Scott says, it makes it a little bit more resilient from an investment standpoint.
And just to add to what you just said, and the lifestyle is much better, right? Like it's affordable, which we would, but some affordable housing, it's not great. Like it's small, or maybe, whatever, really bad neighborhood or whatever you might associate with that. Like we have tenants that have never had a 2-car garage. I mean, it's like, it's like the garage, right? Like, okay. But when you come from the apartment world, you never had a garage, right? I make the joke. I don't know about you guys. I never rented an apartment with a garage. I was like, hump my ass out into the parking lot, right? Unloaded groceries in the red curb fire zone to, or whatever. So that's a big deal. And then, things like just simply having air conditioning. Right. We have tenants. I mean, they're all super great tenants, salt of the earth, but we had some people that are like, not that they don't know how, like it's air conditioning, but like we had one issue with several tenants where they wouldn't run the air conditioning at all during the day. They're at work, and then in California, in the summertime, it's super hot, right? And they get home at 5 and then they crank the air conditioning. And then we get the call at like 9 o'clock at night. Hey, this isn't working, dude. Air conditioning sucks, right? And we're like, did you, was it hot when you got home? Oh, dude, it was like 120 degrees in my unit. And we go, okay, you got to leave it on at 78 or 80 or something, at least get it. So the capability to not only generate the opportunity for them to live together with their family, but they also have these sort of housing style amenities, a garage. I mean, you never think of a garage as amenity normally. But that's what I'm really, when I think about it and I look at it, I mean, we're able to generate great returns to our investors. It's profitable for us, but it serves the families. They can live a great life. And, at the end of the day, usually we're building in neighborhoods where they already were living. Like our neighborhoods are B and C working class neighborhoods. Think like a blue collar working class neighborhood, but it's an A product, right? A brand new unit, big, multiple bedrooms, that kind of thing. So, and I like the idea of next gen. In fact, we got the idea where we put a ground floor bedroom bathroom on every one of our units. So you got the garage, the entry floor, and a bedroom bathroom on the ground floor. And we actually got that from a home builder here locally in SoCal who was building these were detached homes in Torrance. And they had this ground floor bedroom bathroom and we happened to tour it. And I was like, oh man, this is amazing. We're like, who's buying these? And it was families, grandparents, in-laws were, living in this ground floor. Those were homes where you had the living room, kitchen on the ground floor, but we adopted that almost immediately. And in fact, that's a standard design for all, like we want to do the same unit type over and over in a design and construction standpoint for production efficiency. So all of our units now have that.
I like it. Scott, we as real estate investors, we talk a lot about the monetary value of real estate, right? We're obviously in here to provide for our own families and use this as a vehicle to, grow and preserve our wealth. And, we all know that story, right? But I think ultimately too, it boils down to, as what you just alluded to a few minutes ago, about we still have an obligation to provide a value to our community, a service to our community by providing, this type of housing that people can be proud to live in, but also afford to stay in, and just, provide them that safe, efficient, comfortable home that they can provide a roof over their heads to their family. So, again, want to commend you guys for that. That's great to keep that focus. Yeah.
So it makes it much more enjoyable. I mean, I'm not in this business necessarily for joy alone, right? Real estate's a tough business and development tough, but it adds a new component that we didn't necessarily have as just a pure market rate developer. I mean, you always you got to take care of the tenants, right? That's, you got investors to take care of and tenants to take care of. And, we're the bridge between those two worlds. But it's really, it's fun. It's like, we did a video. So for our workforce housing fund, we did a video where we were able to interview some tenants in one of our recent projects. And that was amazing. I mean, these families were like, this is, as soon as we saw this unit, like it was for us. And that was just, from like an ethics and value standpoint, just such a great thing to hear and really sort of cemented. I go, oh, this is why we're doing this, from a, maybe a spiritual or ethical and value standpoint.
Well, it's rewarding, right? I mean, you're solving a problem for somebody that's in a different circumstance than you, and you're giving them something that maybe they may have not had access to before. Excuse me.
Yeah.
And so that at the end of the day is really rewarding. So that makes what we do fun. Like you said, it's really enjoyable. So
more fun. Yeah.
Yeah. Well, look, I want to, as we're wrapping up here, I kind of want to tie this back into the investor side, though. I want to shift gears back. And so, going back to the model here, you mentioned that you're looking at longer term holds, which I was going to allude to that because that's where really we're building our wealth in real estate. Everybody knows that. So talk to us a little bit more about like how the model works as far as, you're going from, land to development, or having an existing building. So I'd imagine there's multiple phases in that, probably multiple refinances in that. So with your investors, are they in a position where they're involved in the beginning, they get the initial upside, they get a cash out refinance, and then they're out of the deal? Or, talk to us a little bit more about what the investor model looks like from that perspective.
Yeah, appreciate it. It's really both. So we have investors that want to just do what I call a merchant investment, build it, rent it, sell it, right? No perm loan, no refi, no long-term hold. And then we've got investors who, and so of course they get the upside of the development, cycle. Yeah. And then now we're moving towards, so we just finished raising capital on a smaller deal in Bellflower, which is the next city over for us in Long Beach. And that one, the investors are going to come in early. And then basically the philosophy is, hey, look, we're going to hold this, forever is the story. I tell them, of course, no one can think about forever. So we go, hey, look, we're underwriting on a 10-year hold basis. We'll give some people redemption rights, if they have an emergency or, if they pass away and their estate needs to get out, but limit the redemptions because, we really want, hey, people who are oriented like us to long-term holds. And we're moving more and more that way. In fact, the formation of, what we call Urban Pacific Workforce Housing Fund was in essence to capture a little bit longer timeline. So to move out of that 2 or 3 year cycle of build it, rent it, sell it, the fund will have a 6-year life. And so that'll give us the capability to, hold, over a 6-year period. And, you guys are, there, inflation, for the next handful of years, is it 2 years, 3 years, 5 years of inflation? There's probably a recession in there somewhere. But for us in California, a lot of people don't like California because it's like a tough place to do business, regulatory, political environment, particularly for development. But I look at it this way: if you can figure out how to maneuver in that area, it becomes like a moat, right? Like, Berkshire Hathaway, right? Warren Buffett has this idea of moats around the businesses that he owns. Like it's a protective space. And I see it that way. A lot of people don't want to be in California. And I go, that's great for me because we've figured out, at least for this period of years until it doesn't work anymore, or changes or whatever's going to happen in the future. But we're happy about that. So did that answer your question? Let me check, make sure.
Yeah, man, it sure did. Yeah, it did. And, the reason why I bring it up is, a lot of our investors that we're interacting with day to day, they're looking for alternatives, right? The traditional syndicated model, the value add model, it's harder and harder to get those yields. And so people are looking for, hey, how do I maximize my investment life cycle? How do I get the maximum amount of equity upside or whatnot? And so, like I said, development has always been, that opportunity. And particularly this type of space. So I think that the angle that you're taking and really attacking the need here in the workforce housing space, again, is just going to give you longer longevity because that's just such a need right now. So really like what you guys are doing.
And we like accelerated depreciation.
Hey, yeah. Everybody likes some tax savings, right?
Yeah.
It's not about how much money you make. It's about how much you keep, right?
Amen to that, brother. Yeah, definitely.
Awesome. Well, Brian, anything for Scott before we get to our final four here?
No, I agree with the kudos we've given him. I think you have an awesome solution to a big problem we have as a nation. And this is just a great way for investors to get involved. So I would encourage them definitely to reach out and look into this because I see this model definitely growing. So keep doing what you're doing, Scott.
Thanks, Brian. Appreciate that.
Absolutely. All right, Scott, you ready for the final four here?
Yeah, let's do it.
Awesome, man. All right, rapid fire here. So what do you like to do for your continued education to further your own investing?
So I'll answer it sort of in a bigger picture than just investing. So I'm always looking for new ways to approach business generally, like think fundamentally. So my main continuing education, I don't call it that. I call it competitive learning. Is I study with a group called the AJI Network, AJI Network, and basically the idea is to work with a group of people who thinks very, very high level and strategically and fundamentally, right? To be thinking about any business that you operate in, whether it's real estate or, really any business you can think of, like what are the fundamental characteristics about humans, interrelate in a business environment, think, trust, and value, right, that we need to produce as business owners and people who accept investments from real estate investors would be the way I think of it. So I do that. So this is an ongoing, probably several hundred hours a year of work together with the group, reading on my own. And then, just for me, it's like I'm in a constant hunt, in the, world of media, of, the industry, real estate media. I subscribe to several newsletters, and I'm always looking for like the new thinking in the marketplace. What's the new trend? How do you deal with it? How to anticipate it? So reading books like, The Sovereign Individual, Bitcoin Standard is a great book, Stephanie Amos. Price of Tomorrow by Jeff Booth. These are like books that I'm reading more recently. The Fourth Turning is a pretty good book. I'm reading that now. And so it's really to try to not so much, so I've got my fundamental learning with this one group. And then the other part of it is like to look into the future as much as I can. In fact, my terminology for that I've adopted is signal from the noise, right? So those articles I clipped, right, that showed the market's great and I'm getting out, like that was the signal in the noise of the marketplace. And so my job now is to try to identify trusted signals of economic conditions and cycles in the future in order to best manage strategically my business, so we avoid, breakdowns and produce competitive advantages. And by the way, that last part, that's what we study at AGI.
Nice. Excellent. I have to take a look in that, learn a little bit more about the AGI network, Brian. So Scott, looking back at your 20-year plus history in the commercial real estate space and development space, what was that one moment of time or one event maybe that really changed the course of your business?
I think it was the creation of this UTH model, and I'm not like trying to sell that. But the way I think of it, guys, is this is the first time that I was able to think completely independently from like what everybody else was doing. Right. In fact, I specifically wanted to avoid that. And, so the business of one, I've sort of seen what everybody else is doing. Maybe you follow them, maybe you don't. But, you guys know it in your own business, like there's lots of people who follow the crowd and then, if the crowd gets in trouble, then you're in trouble. And so I'm like, let's stay out of the trouble. And so this was, when UTH finally cemented, I was like, okay, this is the first time that I've been able to create an innovation. I mean, we've innovated in other small ways. Urban infill was an innovation because no one was doing it at the time, but it was the first like really strategically designed business model, and it evolved, right? It wasn't, didn't plop out perfectly by no means, but I was like, oh, this is what this looks like, to innovate appropriately, to think strategically, to not follow the crowd, to, do something that's uncommon. And it worked, right? That was a great story when you did all that innovation and it made money, and you had happy investors and happy tenants. So, that's been over like a 6-year period. So probably I would say 3 or 4 years ago, I finally got, oh, okay, this works. This is unique. And, this is great. And then the story is, how long does it last? Economic cycle wise, so always vigilant that way.
Sure. Well, Scott, what advice would you give to the listeners and the audience to help them grow their businesses?
I think it's back to this competitive learning idea, right? And when I say competitive learning, it's, if you think of how everybody in the global marketplace, using computers and the internet to compete with each other on a global basis, you start to look at, well, who's out there who's learning and getting new ideas and creating new innovations, and how do I do that in a way that's superior in the marketplace so people will invest with me, or people will buy my product or buy my service. And so competitive learning is learning new things to compete more effectively. And when I say compete and innovate, it doesn't need to be earth shattering. Like I'm Einstein and I created the theory of relativity that nobody, now we're talking not incremental per se, but as Toby Hecht, who I study with the AGI network, he says, look, you just got to be ahead of number 2. And it doesn't have to be by miles. It could be, if you're running a race and you're going to win a marathon, you only got to be a few inches ahead of number 1 or number 2 rather. And so I've sort of, so it's, like thinking in terms of that. And it's an ever ongoing process, right? You never could stop innovating, and companies do, and people do. We see that, right? The Xeroxes of the world, all the companies that we know that just missed it, right? They don't exist anymore. Kodak, film, didn't pick up on the new trends. So it's really to focus on constant competitive learning, apply it to your own domain. In fact, I don't really anymore read real estate industry media to find any new ideas. I do it to track what people are doing in the marketplace, to understand the marketplace. But most of my ideas for innovations come from outside the real estate business. I read whatever, I hate to even use the word magazines anymore, because, magazines are like, sort of a, dead and dying industry. But, think of things like, Wired magazine would be an example that I can think of right now, where it's like, yeah, that's tech, that's, cutting edge, non-real estate, and so what can I glean from that both shows me new ways to think about my existing business, and also gets me that signal from the noise idea, which is to find the new trend, find the future of it, and then how can I apply that to my own business.
Awesome, man. Great advice. Really love that. Thank you so much for that. So Scott, tell the listeners how they can learn more about you and Urban Pacific and get connected with you.
Yeah, so I would encourage people to go to our website, www.urbanpacific.com. There's a bunch of stuff there. Like if people want to learn more about investing in real estate development, or learn about real estate development, we got a ton of knowledge that we've videos and articles that we've written. There's a red button in the upper right hand corner. Hit that, sign up, and we do a Saturday e-blast. And what that is the culmination of all the week's reading that I've read, the signal from the noise idea of articles about, what's the new trend. This morning I was reading an article about wage growth, right? Like that's a real key thought process, right, for me now, is like, how does wage growth work inside this inflation story that we're in? It's not even a story. It's like, actual inflation, because that's a real key place that where we live, and starting to look for, new ways of how people are, identifying the trends, what are the trends, what would the future hold for that? So that Saturday e-blast, basically that's the, sort of collection of articles that we've read for the week that we think are interesting.
Awesome. Well, Scott, I want to thank you again so much for tuning in with us today, man. Great conversation. Looking forward to learning more about you and Urban Pacific, man.
Thanks, Cody. Thanks, Brian. Appreciate it, guys.